Most people think credit card companies only make money when you mess up, carry a balance, miss a payment, rack up interest. And if you're one of those responsible people who pays in full every month, you assume you're beating the system. But here's the thing. They're not losing money on you. In fact, they built an entire profit engine around people who never pay a cent in interest. In today's video, we're breaking down how credit card issuers turn your good financial habits into billions in profit, and why merchants, not you, are often the ones footing the bill. Because once you understand how the money actually flows, paying on time stops looking like beating the system, and starts looking like playing a different game entirely. Before we follow the money, we need to understand that credit card companies think about customers in two categories. First, there are revolvers. These are people who carry a balance month to month and pay interest. This group is a huge profit driver. Revolvers make up around 60% of credit card accounts, but they generate roughly 85 to 90% of issuers' revenues after rewards costs are factored in. Then there are transactors, people who pay their cards in full every month and never pay interest. At first glance, they look unprofitable. As the simple logic goes, no balance carried means no interest charged, which means no money made. But that's not how the business model actually works. Credit card companies don't just make money from interest on balances. They make money from fees charged to cardholders and fees charged to merchants every time you tap or swipe your card. So even if you eliminate interest entirely, the other two streams still generate credit card companies significant revenue. Now let's talk about that merchant fee. Here's how it works. You buy something with your credit card. When you check your statement, you see the full price of what you bought. Let's say $100. You might think the merchant just made $100 from your purchase, but that's not true. For a typical credit card transaction, the merchant pays a fee, typically around 1.5 to 3% in the US, and capped at around 0.3% for consumer credit cards in the UK and EU. That merchant fee then gets split between three players: your card issuer, the payment network like Visa or MasterCard, and the merchant's bank that processed the payment. And guess who takes the biggest slice? Your card issuer. So if you buy $100 worth of groceries, the supermarket might receive $97 to $98. That missing $2 to $3 gets carved up between the banks and the network. Out of that, your card issuer might keep something like $1.5 to $2.5 as revenue for that single transaction. Now scale that across millions of cardholders tapping dozens of times per month. In the US alone, credit cards process several $1 trillion in purchases every year. Those tiny slices on each transaction add up to enormous fee income. Big issuers like American Express, Chase, Citi, and Discover each generate tens of billions of dollars a year from their credit card business alone, with a significant chunk tied directly to these transaction fees. This is why credit card companies want you to use your card constantly. Every purchase you make generates fee income, which means money for them. Interchange, however, is only part of the story. Like we mentioned before, there are other ways issuers profit from people who never revolve a balance. First, there are annual fees. Many premium cards charge $100 to $200 or more every year. That fee goes straight to the issuer, whether you carry a balance or pay in full religiously. At the extreme end, some ultra-premium cards charge annual fees north of $600 a year. If you carry one of those cards, the issuer gets that fee up front before you've even made a single purchase. Then there are other cardholder charges, foreign transaction fees, often around 3%, balance transfer fees, cash advance fees, and occasional late fees. Transactors avoid most of these, but across the entire customer base, they add up. And then there's the big one, rewards. Your 1.5 to 2% cashback doesn't come out of thin air. On many purchases, the issuer is taking a chunk of the merchant's fee and giving part of it back to you as points or cashback. In some cases, the reward rate is close to or even exceeds what the issuer keeps on that transaction. So, on a $100 purchase, the merchant might pay around $2.5 in total fees. Your issuer's portion might be around $2. If your card pays you 5% cashback, that's $2 straight back to you. After the issuer covers their share of network fees and processing costs, there's almost nothing left for them on that specific swipe. So why do credit card companies do this? Two reasons. Number one, issuers know that even disciplined customers occasionally slip, carry a balance for a month, pay interest once, or get hit with a fee. And that interest and fee income from revolvers help subsidize the cost of rewards across the entire portfolio. Number two, rewards are a customer acquisition and retention tool. High-spending transactors generate a lot of interchange revenue with very little credit risk. Issuers are willing to give some of that back to keep you on their card instead of a competitor's. But here's the reality. A typical revolver can be worth many times more in annual profit than a typical transactor, because a revolver is typically generating high interest on a large lump sum of debt, month after month, whereas a transactor only generates small interchange fees on individual purchases with no interest at all. In other words, the people paying interest are often subsidizing the points and cashback earned by the people who never do. If merchant fees are such a big part of the model, you might wonder, why do merchants put up with it? From a store's point of view, that 2 to 3% fee is painful, but refusing cards is usually worse. Research on payment behavior shows that offering credit card payment options can increase conversion rates and average order value. People are more likely to complete a purchase and spend more when they aren't limited to the physical cash in their wallet at that moment. For example, a merchant pays a 2 to 3% fee, but conversion goes up, and average basket size rises. Overall profit can still end up higher than if they only took cash. On top of that, there's competitive pressure. If one retailer accepts all cards and another insists on cash or debt only, the card-friendly store often wins the sale. So merchants end up paying the fee, not because they want to, but because refusing would cost them even more. So after all this, you might be thinking, if I pay my balance in full every month, I pay no interest, and the merchant covers the fees. Am I in the clear? Not exactly. Those fees don't vanish. Over time, they get baked into prices. So even though you're not paying fees directly on your statement, you're still paying them somewhere else, through slightly higher price tags across the board. But here's what you should take away from all of this. First, you're part of the system, not outside of it. Credit card companies expect a mix of revolvers and transactors, and they've structured the model so that both groups can be profitable, just in different ways. Second, if you're disciplined, you can still come out ahead. Merchant fees get backed into prices so everyone pays a bit more. But if you're earning rewards, you're getting some of that back. Cash users aren't. So while you're not beating the system, you're playing it better than most. Third, remember that the system is built to encourage spending. High limits, smooth checkout flows, and attractive rewards all nudge you to put as much as possible on the card. From the issuer's perspective, the ideal customer is someone who spends a lot, never defaults, keeps their transactions flowing every month, and throws in the occasional missed payment. So credit card companies don't need you to fall behind to make money. They just need you to keep swiping. Whether you pay interest or not, every transaction generates profit for them. Paying on time isn't beating the system. You're just playing the role they designed for you. So the next time you pay off your credit card in full and feel like you've won, remember, the issuer just collected a fee from every merchant you bought from. You didn't lose, but you didn't beat them either. The game was never about whether you pay interest. It was always about whether you keep swiping.